cool. Well, I want to start by thanking Danielle for the awesome question this weekend. And let me point out ahead of time, this is like, we love when you guys, the agents here at Realty One Group, give us ideas like this, because we're often like trying to scramble to like, we want to provide value and not waste your guys' time with these meetings and not just, fill air. So if you guys ever have questions like this, say you're like, hey, I think it'd be great to have a class on this, or just answer this question, please post about it like Danielle did, because it was a great meeting idea. And so then I also want to thank Craig Benson with Caliber Loans for joining us today. I've worked with Craig for a couple years, and he's a very knowledgeable, great lender. And so Craig, thank you for taking the time. Are you going to be sharing your screen? Do you want me to make you the host, or are you just talking?
I'm just talking, and thank you so much for having me, by the way. I really appreciate it. It's great to meet all you guys, those that I haven't met, and great to see all you that I have met before. So great to see you guys again.
Sounds good. Well, I'll just let you take the floor, and then guys, I think Craig has some stuff that I asked him to talk about, and then at the end, I kind of want to open it up, question and answer. The main focus was to talk about how COVID is affecting lending in general. But if you have other basic lending questions, now is a great time. So Craig, the floor is yours.
Yeah, so the main question was when it comes to being in forbearance when trying to sell your home. Is that correct? That's where we're sitting at with that one. Cool. Just want to make sure. So the biggest thing that you're going to see, actually, like, it can be done, no problem. It's the loan amount is due, and it's going to be, here's what the payoff is. As long as that's paid off, we don't really care. Good to go. What you will see, though, for your sellers, if they are still in forbearance when they sell their home, is that it has been popping up as it was sold, but it was in deferment. And so that will stick on their credit report until they get a credit supplement on there. So ideally, everybody wants to be out of forbearance before they sell their home, so they don't have that hitting their credit. Does that make sense?
Kind of. Can you elaborate on how that affects them? Obviously, it would affect them if they're also getting pre-approved to buy a home at the same time, right? But then how fast does that get off of their record? Does it go away once they officially close? How does that work?
No, so we can stick on there for a long time until you get a credit supplement put in there through the credit agency saying, hey, this was paid in full. So it won't say that it wasn't paid in full, it just will say deferment on there. We've seen it pop up a couple different times. And so it's really something that the borrower then has to go through, or the lender, if they're trying to buy a new home, and do that credit supplement on there to say, hey, this was paid. It wasn't a short sale or anything like that. So just take this off of there, but it can't impact your credit scores until it's taken care of.
How big of an impact are you seeing? I know that's a hard question to answer, but are we talking 100 points, or are we talking like 30, 40?
It's going to vary, but about 30, 40. You're not going to see a 100-point swing on it or anything like that. And it also is still a little bit too early to tell really where the floor and ceiling is on it, because we're just starting to see them a little bit pop up now, but it's like 30, 40 points. Like it's still a good sizable hit, obviously, for something that has been taken care of in full. So again, ideally, you want to be out of forbearance before you sell your home.
Okay. And so ultimately, if you have a seller who is asking this question, hey, I'm in forbearance, how's that going to affect selling my home? I'm going to repeat what I heard, and then you can correct me, but you're going to say, it doesn't really affect selling your home. It's essentially like it's almost like a second lien on the property. Is that correct?
Yeah, basically.
Okay. So you have what you owe on the property, then you have what you've deferred. Deferred is probably the wrong word.
So I wouldn't even say that it's going to be a second lien, to be honest with you, because the amount that you owe is the amount that you owe, and the deferment is just your payments. You still owe that exact same amount that is your note all the way through. So it's not really even a second lien. It's just saying, hey, it was in deferment though for these payments going on. That's all it's saying on there.
And are there penalties and interests on top of that?
I mean, there's always going to be an interest that you owe on your note loan, but it's just whatever the note is, that's what it is. There's no penalty on it or anything like that, as long as it's paid within full. Most companies are not going to care. I can't speak for every company out there, obviously. Some lenders are going to be pickier than others depending on the institution. But in general, it's just the same thing as doing any other payoff that you normally would do.
So it's really actually a simple answer. The answer is it does not affect you selling your home. You have to pay off what you owe, and you obviously owe what you owed in May when you stopped paying. Regardless, all it affects is your credit. Your credit, I'm sure you've noticed, has gone down since you went in deferment. And so when you go to buy a home, this is going to affect your interest rate or if you even are able to buy a home now. And that's where I would probably try and, we always talk about this when someone asks you legal advice, we can kind of like hint at it, but we're not lawyers, right? When somebody asks lending advice, we can answer simple questions like this, but that's where you try and say, so that's the gist of it. Now let's go talk to a lender really quick, but answer the question. No, it has no effect on you selling your home, but it does affect you buying a home. So let's get you in touch with the lender and see what we can do to lighten the blow.
Absolutely. Yeah. And for sure, I mean, don't put out any for sure answers to anybody when it comes to lending stuff. Know enough to be dangerous, but always refer to somebody so that your hands are clean, because again, it's your reputation on the line there.
And if in doubt, just say it over the phone. Don't put it in writing.
Always.
Going back and saying like, you told me this and here's the email that you said it. Danielle has a question. I'm going to mute myself.
I'm like, is that appropriate to raise your hand? I don't know. I didn't want to interrupt. So 2 things. The deferment will show on credit. So it's actually for my clients I'm meeting with later today. They are not in the financial spot to step out of that deferment right now. They're not even planning on purchasing right away. So their plan was to pay off everything, get back on their feet, because they are struggling in 2020. So they can do that. It just will hit their credit, and then they'll have to wait till their credit goes back up to purchase again, right?
So it's not even a guarantee that it will hit their credit. We have seen it pop up. It's not 100% of the time. So it's kind of a crapshoot on it, to be honest with you. So
I'm kind of like, I'm interested to see what that comes back as, or would it be more when they request a payoff from the lender?
For what they owe?
What they owe, yeah.
Yeah, so it would still be the exact same note amount. I mean, that's what they owe. And deferred payments is just, hey, we're going to push this back. You try to make as much as you can on your payments and forbearance here. And it always going to add up to the exact same amount going on, unless they went into a loan modification or something like that, which is a completely different ballpark that we're talking about. Yeah. So the note amount is going to be the note amount. And it's just basically at the end of that forbearance period, it's basically like, hey, now all this is due on this back pay. Do you have this, or do we need to move into a loan modification?
And that's what I was thinking, because I'm like, they can't increase what you owe. What you owe is what you owe. Because like some people on the thread were like, well, you're going to owe your loan amount plus fees plus the missed payments. And I go, but I'm thinking mathematically that's more than the loan amount. It just was never paid off. So the loan amount stayed the same and just never got smaller, and interest accrued.
Yeah, and depending on the institution as well. I mean, there could be some fees associated with it, which get added to your payoff. I mean, your payoff is never the exact amount that you owe. Right. There's always the interest that you owe. And then so there might be some unpaid fees that are added in there, absolutely. But in general, yeah, that's how it's going to work.
And I was doing their net proceeds. I'm like, okay, well, you've missed, I think it was like 5 payments. So I'm like, well, if you have to pay that back, plus the loan, plus fees. So it might not be as scary as the rumors that are going around are making it seem.
No, it's not. And for you guys, if you guys are trying to do this, just for payoffs in general, usually take whatever their monthly payment is and add on a monthly payment to their loan amount. And that usually would be about what their payment will be for, or payoff will be for accrued interest and everything like that as well. So that's a general rule of thumb. It can be more, it can be less, but that's a really good ballpark of where they'll be sitting for what their payoff will look like.
Well, I appreciate that, because it seemed like there was going to be fees on top of fees on top of payments on, and I'm like, that's so much more. But okay.
Yeah, I mean, and the fees, they could be there. Again, it's going to depend on the lending institution, but they shouldn't be astronomical.
Okay, I appreciate it.
Yeah, absolutely.
I have another question, and I unfortunately know the answer because Craig and I were just talking about it this morning with the buyer I sent to him. But I think it's a good thing to talk about. Craig, can you talk about all these people who had full-time jobs who have now been partially or fully furloughed? So like the buyer I sent to Craig, she went from 40 to 20, and now she's down to 10 hours a week, and she's making unemployment, but she only has 10 hours a week. How does that affect her loanability? Because, if she was making 50,000, now she's only making 25% of that. How does that affect her loanability?
Yeah, so this has been the major impact for most borrowers when it comes to COVID. And it's really, I mean, once they are back to work, they need to see that, yes, they are actually back to work. So obviously pay stubs going on, verification of employment going on as well. But if you're at reduced hours or reduced rate of pay or anything like that, you have to go off of that new amount. And so it doesn't matter what you made year to date, unless you're going to be self-employed, then there's other ways to go around that. But there's a lot of hoops jump through for the self-employed as well. But you have to go off of that rate of pay that they are being paid at then. So ideally they want to be stabilized back at their 40 hours, and then you're good to go moving forward from there.
And when they go back to 40 hours, hopefully, does that immediately, do they kind of disregard the fact that they went back, that they were doing 10 hours for a few months? Or does, I mean, obviously that's going to show up on their tax return in 2020. It's going to show that she didn't make 50. She actually made, 40 or 35 or whatever. So is that going to have an effect?
Yeah, and so it's going to really be up to the underwriter at that point, and they're always fun. I mean, no two are exactly the same, but usually what it'd be is if you can show a steady amount of, hey, we are back to this level and we have been for this amount of time, they will be able to go off of that payments. If not, if it's only been a short period of time or it's kind of still fluctuating, they're going to want to do a year-to-date average, and if that's going to include all of the time that they were off. It's going to be included in there. You can't just take those months out and throw them away. They're all in there, and so you'd be going, even if you're off for 6 months, you're still doing a 12-month average.
Got it. Another question along the same lines: when you have a buyer who's been let go, okay, let's say I have a buyer who was let go in May, and then she gets a job in January of next year. So that's 7 months that she wasn't working. But due to the circumstances, is that going to be like, normally you need 2 years of consistent income to be able to use your income? Will that be the case? Or do you, I know you're partly guessing here, right? Because you're guessing on what underwriting is going to do. This is unprecedented times, but what have you been seeing or hearing?
So, I mean, most underwriters are willing to work with people. Obviously, they know what's going on. Like they're normal human beings. They see what's happening here too. A lot of times, as long as they're going to be within the same industry that they were in beforehand, they just need to have a letter of explanation saying why they, like, what the gap of employment really was and why it was there. But if it's within the same industry, usually they're good to go to keep running with it.
What if it's not in the same industry? Because like people that are in hospitality right now, like restaurant, hair, nails, and that, some people are like, hey, this is a perfect opportunity to go on ahead and switch my career because this is like not doing it. So at that point, then would there be a little bit of leeway?
There might still be a little bit of leeway. They still might want to see a couple more months on there, like to be safe, probably about 6 months worth of employment. Because again, they're also want to be like, hey, is this going to continue to go on and everything like that? So they do want to probably see a couple months of employment going on there. But if it's within the same industry, like even if it's like, okay, somebody, this is the example from this morning, somebody sold guitars and then they went into sales for Home Advisor. It's sales to sales, so we can make that connection and be good to go with it. Does that make sense? So there's a bit of gray area where you can dance in with it to connect the dots and everything like that. But if it's a completely new career, usually they're gonna want to see a couple months in it.
I'll also point out that you notice how Craig is a lender and he's even answering these vaguely. And that's really how we should be answering these too, because you'd rather underpromise and overperform. You want to give them hope so that they, do talk to the lender and stuff. But I know I've already said it, so I won't say it again after this, but just be careful to just don't give them enough hope to get them in touch with the lender and really see for themselves. But don't be like, oh yeah, you'll be fine. Like never say something like that. Don't make promises that you don't know that you can keep. I mean, Craig doesn't even know because it's the underwriter and Craig's the lender. So just something to think about, because that can, even though it's not really your fault, that could really piss off a client of yours. And you really want to underpromise and overperform in regards to that.
It's all about the experience going through that you guys want to create. And it needs to be, what's the path of least resistance, which is going to be, here's some vague stuff. Here's where I see there might be a couple of stumbling points, but we're going to get into that as we move forward and go through on this, and we'll get that cleared up. So.
Any suggestions on tips for people who are having trouble getting pre-approved? Like any of those examples we just used. Like one example, obviously, that popped to my mind is saying, hey, do you have anybody who can co-sign with you? Like that's a great option. I mean, a lot of people have parents who have lived in their home, they paid off their home, their debt to income is incredibly low, and they've been in the same job for forever, and it doesn't really affect their parents at all. Or maybe it's a sibling, maybe it's in-laws, whatever the case. So that's one thing that I love suggesting to clients Any other suggestions on top of that, or do you want to elaborate on that?
I mean, really, that's going to be the best way to go forward. I mean, because it's going to make for a stronger file all the way through. Now, obviously, you need to make sure that credit requirements are lining up and credit scores are lining up. They're not going to drop everything down. You need to make sure that there is the income to support it. I've had people who are like, oh, I'm going to put my dad on. He's retired. I'm like, well, he doesn't have any income, so that doesn't really help us as we move through here. So we can't, unfortunately, do that. It doesn't add anything to your file. We just get all of his debts instead. So it actually blows your file up. So debt to income ratio is really huge on there as well. But really, I mean, it's really getting steady work is the biggest thing, no matter what it is. That's the biggest thing if you can do it. And a lot of people, it's like, hey, we have to pause for a little bit and just be honest with people too. And don't go, hey, it's a no. It's never a no. It's a not right this moment. And let's get you on the path and lead you down the right way to get there. But unfortunately, a lot of people are being affected where they're just not going to be able to qualify if they don't have somebody else that can co-sign with them. But you stay with those people and you're like, okay, here's the roadmap to getting you into the home and making your dreams and your goals come true.
Right. It's like, I use this metaphor all the time, but I just think it's a metaphor that works for so many different circumstances. But it's like, if somebody is, in really bad shape, it's not, no, you can never look like that, supermodel. It's going to take some time. And here's the good news. You don't have to pay for a trainer. You've got Craig, who's going to be your trainer for free. We real estate agents, Craig, we work when we get paid when you buy a home, right? And so we're going to work with you through the process, and we're here to train you through the whole process. So don't do this alone. We're here to help you through it. It's just not right now. Let's get that map so that you guys can see the light at the end of the tunnel.
Exactly.
Yeah. Okay. Cool. I like that. A way I explain the and again, Craig, do correct me if I'm wrong. A way I explain the co-borrower to people, if they're confused about like, well, what do you mean I can't use my dad who's retired? Essentially, how they're going to look at it is, first off, they're going to take, of the 3 people applying for the loan, or 4 people, if it's 2 parents and a couple or whatever, or just 2 people, they're going to take the lowest credit score, and that's going to be what the main portion of what your interest rate is based off of. And then they're going to take all 4 or all 3 or all 2 of your combined income per month, multiply it by 0.45. So essentially it's like dividing it by 2, but 45% of that. And then they're going to subtract your monthly debt payments. And then that's the loan that you'd be able to qualify for. And that obviously has to include principal and interest, PMI, taxes, and insurance. But if you explain that to them, you're like, listen, I know that right now, what Craig said is only 40,000 of your income is going to count. Well, if your parents make 150, now that's 190 a year times 0.45. And then, yeah, they have debt, but even once you subtract that debt and your debt, you're still probably having a really good chance. And again, it's up to your parents, but it really doesn't affect them. If they're not planning on buying a home next year or the year after that, it really has no effect on them. Sure, their interest rate is going to have not their interest rate, their credit score is going to take a dip, and there's a hard credit pull, but we're not talking anything dramatic. It's a small effect that it does have on them. So I really try and push that to people who have someone like that in their lives. It's such an easy hack.
Yeah, it's a really great way to be on there. And then you can always refinance and get whoever off the loan after the fact as well. So they're not stuck on it forever. And even if they are actually looking to buy a home within, like, let's say it's 13 months from now that the co-borrowers are looking to buy a home, you can show that the actual borrowers that have been making the payment for 12 consistent months have paid everything. You can actually exclude that from the co-borrowers who are trying to go buy their new home. So it will not affect them if they're even looking at buying a home the next year.
I've got one other tip about it. It just popped in my head. We actually use my in-laws to be co-signers on a recent loan that I did, because my wife got let go. And so, we just didn't barely qualify, but we found a great deal. It was more than we wanted to spend. It was an unbelievable deal. And I was like, I can't miss out on this. So I talked to her in-laws and it worked out. And I proposed to them. I said, here's a way I'm going to protect you though. I'm getting this life insurance plan. The note was like $420. I said, I'm getting a life insurance plan. This is getting high level, so bear with me here. I can explain this in more detail later. This is just something I came up with. I said, I'm gonna get a life insurance plan for myself for $420,000, okay? And I'm putting you as the beneficiary. And as long as you guys are on this loan until we refi and get you off, if I pass away, you're gonna get $420. and then you'll have the home because you'll still be on title and you'll get paid off for the entire amount. And it was, I don't even think I needed to do it, but that life insurance policy cost me like $30 a month. And so it cost me an extra $30 a month to get this loan done. That turned out, it was really an incredible deal. It came with an extra lot. It was ridiculous. And if not patting myself on the back, but the truth is most people would have been like, oh, I only qualify for 375 because my wife was let go. And it's like, well, I guess I can't get that deal. No, I mean, there's so many ways to do these different things. You just kind of have to find a way to do it. And so that's one way. If you have a buyer who's like, yeah, my parents don't really know, they feel like it's kind of risky because what if something happens to us and we can't pay the loan? There's all these different outs that you can set up, and you can say, if I lose my job, I will, we can sell the home. There's all these different options. So anyways, I'm getting into the weeds there, but that was just something that works for us. And I don't know, just an idea.
Yeah, no, I love that, just because, I mean, that's the one thing that 2020 has really brought upon us in this industry is you need to be creative and find those creative means to push through on everything going on. We've all had to adapt and pivot and turn into how we're really running our businesses. And it's also, especially like in the lending field, and also even with that example that Isaac put out there of how do we move forward with things. And so it's been really, really a good year to really get crafty, and then you can use that for the rest of your career.
Absolutely. Does anybody else have any questions? It doesn't have to be specifically about COVID and lending, and it can be any lending questions. I think we're only 30 minutes in, so this is a good time to just kind of have open floor if anybody has any questions they want to ask Craig.
I actually have a question. As far as job history, career path is a little bit confusing, I think, when it comes to nonprofits, because I feel like people kind of jump around from nonprofit to nonprofit under the guise of, I don't know, community resources. Would that be considered a linear career choice, or would that be considered a new career choice?
No, so if it's nonprofit to nonprofit, a lot of the times, if they're going to be within the same kind of realm of what they're doing, like if they're, community outreach and they go to community outreach, or like a similar title in another company, it is going to be considered exact same field going on all the way through. I actually have a client I'm working with who is in the middle of doing that right now. So. Okay,
cool. Thank you.
Yeah. Mm-hmm.
This is another reason, by the way, when you're talking to, when you're interviewing lenders who you want to, kind of be on your team, who you want to refer, obviously I've already spoken highly of Craig. He's great, but make sure, if it's not Craig, make sure you're working with a lender who is like Craig, in the sense that they're not going to be like Rocket Mortgage, right? Fill in these boxes, yes or no, stamp, move on to the next one. Try, when you're referring a lender, make sure it's someone who doesn't just think inside the box. And that doesn't even necessarily mean someone who's been in the business for 20 years. In fact, I would say oftentimes you find those people are ones who just stick in the box because they're kind of ornery and have been in the business and they don't really care to work hard. Sometimes I'm making generalizations here, but find someone who, they don't have to know everything, but they don't say no easily, right? They're someone who will really work for your clients. Because I know I've said this before, but once you get a lender involved, now you've got a team. You've got two people who are working with that buyer and pushing that buyer and supporting that buyer. And so, if you go a few weeks without contacting them and they fall through your cracks because you're not thinking about it, well, hopefully your lender's there following up with them. And so you guys are kind of working together on it. So just a reminder to don't just settle for the first lender who calls you. And if that first lender is awesome, that's great. But make sure you're partnering with someone and referring someone who's really good at what they do.
Yeah, and being creative and going outside the box has been a big thing going on this year for the lending industry, because there's been like the COVID overlays that have happened. It's a weekly change. They're kind of a natural organic thing that is always changing and adapting. And so we've all had to do that as well. I mean, a prime example is I had a client who was trying to buy a $1.25 million house. And they were getting pre-approved through KeyBank, and they're like, we're just gonna do a jumbo loan. Now they're self-employed. And I was like, well, let's just take a second look at everything, run through it, and this would be great. They're showing a 40% deficit in their income. There's like a jumbo loan is already the most delicate program out there in the best of times. When you throw in COVID overlays and declining income of that nature, it's absolutely going to fall apart. Now, KeyBank was like, yeah, no, you're totally pre-approved or pre-qualified. Go for it. You're great. And I was like, I don't care if you go through me or if you go through KeyBank, do not get into a jumbo loan because you will actually lose your earnest money because this deal will completely fall apart. You need to do a piggyback second on here, which is basically a HELOC to make up the difference between the conforming loan limit and the rest of the purchase price there. You can put down 10% and then you have the HELOC and your high balance loan going on. I'm like, this is the only way that you are going to be able to get into this home. Any underwriter at any company will eat you alive. And so being able to even offer that, I'm like, I don't care if you go through me or you don't go through me. Like, choose whoever you want to go through, but you guys, I need to look out for you guys first. And that's the number one thing, guys. If you look out for your clients, they are always going to be so appreciative, whether it's with you or with someone else. They're always going to remember you, and that's always going to stick out with them.
Absolutely. Let's just spend a few more minutes. Jumbo loans are a great topic, and it's a huge topic. So maybe it's just a common question you get. Maybe just talk, I don't know, we'll fill the last 5-10 minutes with just talk about jumbo loans and how that has been affected by COVID. I know it's one thing that has been majorly affected by COVID. So if you can first, just we do have some agents who are newer on the call. Can you first, like, what is a jumbo loan? How does it change county by county? And how has it been affected by COVID? If you don't mind.
Yeah. So yeah, absolutely. So you're going to have 3 different tiers of loans, really, that everybody kind of fits in. You have conforming, you're going to have high balance, and then you'll have jumbo loans. Conforming is at 510, 400 for this year. It's going to change for next year. High balance loans are up to 741, and then anything above that is a jumbo. So you have to fit within these limits, otherwise you go to the next tier. Jumbo loans, obviously, being the highest tier and the highest loan amount, they come with the greatest risk to the lender. So they want everybody to jump through all of the hoops they possibly can to prove that they can actually repay those loans. One of the biggest things that really almost kills almost every jumbo deal going on right now is the reserve requirements that are now in place for COVID-19. At least for my company, I can't speak for every company, but it's pretty much across the board. But for my company, you're seeing they need to have 18 months of reserves. So that means 18 months worth of the monthly payment in reserves to even qualify for it, which is just astronomical. That's a huge amount of money. Usually it's satisfied by 401ks or stock options. The other thing, though, going off of stocks, so any market-based assets, when they are being analyzed to be used as qualifying income for anything, they have to take it at a 70% of what the value actually is, just to put into place a protective layer in case the market shifts. So even if they have a bunch of money in there, you have to make sure that you're going at 70% of the value of that to make sure that they're good to go all the way through. So that is the biggest thing that holds everyone back on jumbo loans, is really that reserve requirement. It's pretty gaudy. Most people that also get into jumbo loans, a lot of times they're self-employed, and there's all those fun overlays that we kind of went over earlier too, that really affect what's going to be allowed and what's not going to be allowed for jumbo loans.
Are there other non-liquid assets that can be used for your reserves, i.e. rental properties, equity in your home? Well, that obviously doesn't work because you're selling your home to buy a home, but yeah, rental properties. I'm trying to think of what about if you own a business? I don't know, can you use the equity in that business, equity in your rental properties to help?
So again, if you own a business, it's usually not going to be equity that they look at in the business. What they're going to be looking at is really the health of the business and what you're being paid off of it, and how is making sure that the year-to-date P&L matches business income for the business bank statements, anything like that. Rental income is a really cool topic, actually. A lot of times, to be able to use rental income, you have to have reserves, 3 to 6 months of reserves going on. You have to have experience, meaning that basically you have tax records saying that, yeah, hey, I have a rental property, I've been paying taxes on it. And then you can use 75% of what that total rental income is per month. You can use 75% off of that to offset the mortgage on that property, obviously, and then put the rest towards your actual income. If you don't have that rental history, you can only use 50% of that. So they've all been impacted, and that's to put in place in case of vacancies happening all the way through.
But if I have a rental property that is worth $400,000, I owe $200,000, I'm making $600, and I have per month in cash flow, and I've been doing that for over 2 years. Does any part of that 200,000 in equity? Nope.
No, you'd have to get a
Right.
HELOC because right then and there, it's not like you don't have instant access to that.
Right.
You'd have to go and apply, get a HELOC or for a refinance. So they don't care how much you own on that property. It'd be really cool if they did, but they don't care. They're like, it's not readily available. Like tomorrow, you can't go and give me that money.
But a HELOC would work.
HELOC would totally work, but then you also have to take into consideration you're going to get hit for that HELOC payment all the way through too. So that's going to affect your debt to income ratio as well.
Well, you don't have a payment though if you have 0 on the HELOC, right? So sorry.
If you have 0 on the HELOC, yes, but then if they're saying, hey, but we need to see this much available, like they usually say, okay, so for the amount that you would need just in case, we want to basically add that in and put that formula in as a worst case scenario to make sure that it will not impact your ability to repay.
Oh, I understand. So just to break down these terms a little bit, using my example, if I have a rental property that's worth 400,000, give or take, and I owe 200,000 on it, and I'm making 500 a month in cash flow, they're going to count that cash flow as part of my income because I have tax returns to show it, right? That's just income on top of, my W-2 income and my 1099 income and all that. But then but that doesn't help me. That $200,000 is non-liquid, right? If I need $200,000 tomorrow, I can't just do anything except for sell the home. That's really the only way to access it. But one thing people can do is they can get a HELOC, which is a home equity line of credit. And HELOCs only charge you, sometimes there's like yearly fees, but forget that. HELOCs only charge you when they're in use. They generally charge you interest only payments when they're in use. So if you take 20,000 out, they're going to charge you whatever it is, 8%, 9%, 10% of 20,000 amortized over a year as a payment. But if you have a 0 balance on your HELOC, then you could, in using this example, normally you can get a HELOC up to 75% of equity in your home. So 200,000 of the 400 would be 50%. So you can get another 100,000 HELOC. I'm using really simple numbers on purpose to try and in a perfect situation. So then you would be able to use that 100,000 as part of your reserves if you had an active HELOC to do that. But then you'd also have to subtract your payments, the interest only payments on the 100,000. Is that what you're saying?
Yeah. Mm-hmm. Yeah. Whatever that fully amortized payment will look like for the HELOC is what they want to look like. Okay. Worst case scenario, here we are. And HELOCs are really a special thing too, because there's usually a 10-year draw period. So you only have 10 years where you can really actually draw money out of it. And then there's 20-year repayment period. So you have to make sure that you're within that draw period too. So a lot of people are like, oh, I have a HELOC. And it's like, well, when did you actually open it? Because you can't actually draw any more money out of that and you've been capped. Right. So, and the other thing that we saw, we didn't see it kick into play this time around, but in 08, 09, or 07, 08, most HELOCs immediately banks went, nope, you're capped. You're not drawing anything else out. When the economy started going down, there's like, absolutely not. It's not happening. We're done. Whatever you drew out, that's what you have. You can't draw anything else out. So that's a risk that's also with HELOCs right now, especially with the market going the way that it is, where there's a lot of uncertainty in it and variability going on. So.
And again, the moral of the story here is not necessarily so you can take this and problem solve and figure out a way for your clients to be able to get a jumbo loan. Really, the moral of the story is get them in touch with a lender, but just because they don't have 18 months in reserves, there are ways to do it. That won't even necessarily mean liquidating stocks or liquidating real estate, but there are ways to do it. So obviously, as always, get them in touch with a lender who knows what the heck they're doing.
Yeah, and if you guys ever have any scenarios that you just want to bounce off of somebody, like you can ask Isaac. My phone's always on. We probably talk 4 or 5 times a week. Isaac and I just bouncing scenarios off one another, and it's awesome. So I'm always open for that. So give me a call, shoot me an email, shoot me a text, whatever you guys need to do. My phone's always on.
Awesome, thank you. Hey, I have a question really quick. So with the COVID situation and a lot of people staying at home, what is it like for someone going through closing? Do you do closing online now or through Zoom, or it has to be in person?
So it's going to depend on the lender. We still require in-person closings. And so it is going to have to be, hey, go to the office, or they can try to come to you, but most of them want you to come into the office so that they can control the situation, what it looks like, and how to sanitize and everything like that. So a lot of times that is happening. Notaries can usually go out too, and they usually will just sign in the driveway of wherever they are to keep that social distancing going on too. But yeah, my company does not allow e-recordings or e-signatures on final documents or anything like that. It all has to be wet signed all the way through. And so each lender will have their own policy on it, but that's just with Caliber is all the way through there.
Oh, gotcha. Thank you for clarifying.
Yeah, so
Also, heads up, guys, Shannon Zimmerly in our office is a mobile notary. So she's happy to help you guys. Just shoot her a text. She's super responsive.
That is a huge resource. That's awesome.
Yeah. So in general, if it's a cash transaction, there's no rules. You can do, I mean, if everybody wants to, they can all do virtual signing with escrow. So it's not, a lot of people think escrow is the one who dictates it. Escrow doesn't care. It's all about the lender. And if you have a client who's really nervous about COVID and they're like, well, I don't want to, I want to be able to just stay at home and do this all from home. Whether it's a seller or a buyer, you can tell them you really don't have to meet with anyone or do anything until the day before closing or the day of closing when you sign. And notaries, I mean, I just did it twice recently. They come in, they wear a mask, they have gloves on, they use hand sanitizer, they can do it outside. They can keep 5 feet away from you and just say, okay, you're going to sign this and explain it. So if you have someone who's really nervous, just try and reassure them that it's really, notaries are really good at being conscientious of everything going on. They're really respectful of people's space. Okay, well, that was awesome. Thanks, Craig. Thank you, everyone.
Yeah, no, thank you so much for having me. That was awesome, you guys. And like I said, if you guys have any questions whatsoever, give me a call, shoot me a text, send me an email. I'm always open to have conversations with anybody in any scenario going on. Even if I'm not the one helping, I don't care. I want to be able to help you guys out the best I can all the way through.
Awesome. Thank you.
Yeah,
Absolutely.
thank you.
Absolutely.
All righty, everybody. We'll see you Thursday, maybe at Rev Up. And if not, we'll see you when we see you.
Thank you.
See you on Thursday.
On Thursday.
Have a
Bye,
great one,
guys.
everybody.
Bye.
Bye.